All right, we are live. So welcome to everyone joining us. Welcome to our panel members here. I'm going to go ahead and introduce everybody, and then we're going to get started into a really exciting topic. I really feel like this topic is the most important topic when it comes to investing in real estate is who you're actually investing with. And because there's a lot of things that can go really well and there's a lot of things that cannot go very well. So we're going to get into that topic. We're going to unpack it. We're going to give time for questions. We're going to have an interactive time. It's going to be awesome. So again, welcome. So my name is Bronson Hill. I'm the CEO of Bronson Equity. We are multifamily. We're multifamily. We do multifamily investing, and we have 800 multifamily units under management. I'm going to go through and introduce each one of our guests and just get briefly into that. And then we're going to go ahead and get started. So first of all, we have Christina Suter. Would you wave, Christina? Okay, that's Christina. She's the founder and CEO of Ground Level Consulting and is the president of the Phoebe Pasadena chapter, which she co-leads with me as well on the multifamily side. She's a longtime investor in residential and commercial real estate, along with small business investments. Her podcast, The Real Estate Breakthrough Show, talk about the quality of real estate and the mindset you need and tips and tricks to get you moving forward in investing. So welcome, Christina. Next, we have Spencer Hiliga. Spencer, welcome. So he's the principal and co-founder at Madison Investing. He is a passive real estate investor, co-sponsor, and former technology leader. His company, Madison Investing, to date, they have partnered on deals totaling over 6,000 units and more than 800 million worth of transactions, bling, bling, across multifamily, self-storage, and other niche asset classes. Now he is focused on spending more time with loved ones and helping others reap the same benefit of cash flow investing in real estate assets. Next, we have Ellie. Hi, Ellie. Welcome. My daughter's name is Ellie, so I feel a special bond with Ellie because I just think Ellie's a great name. And Ellie's a great person, too, so welcome, Ellie.
Thank you.
Ellie Perlman is a real estate investor, syndicator, operator, and brings you the ready-to-scale podcasts. She paints a picture of her own humble beginnings, and basically she is a multifamily operator. It looks like the bio I have is a little more focused on your podcast, but I know you're a very well-established multifamily syndicator, operator, and you're doing quite a bit of work out of the South. So welcome, Ellie, and we'll go ahead and jump into it at this point. But let's just take a minute and talk about that. So for each of you here, I invited you here because I want to really talk about it. I feel like each of you have a different background. I know Ellie is more an operator. Spencer is a passive investor, and then also brings deals together. And then Christina actually is a paid consultant that works for individuals that are looking to vet deals. And so you each have a very unique opinion that you can bring to this. But let's just kind of go around and say, why is this question so important? Why is it important who you invest with? Why don't we start with Christina?
All right, I want to turn my mic back on. So I have noise in the background. I apologize. So I would say that it kind of sums up into a basic package. A good expert who's running your deal, whether it's your deal, your syndication, your fund, can absolutely take a mediocre deal and make it great, can take a great deal, make it fantastic, and can take even a deal that you might have some questions about and make it work. But a syndicator or an operator that does not have the strength, the experience, or the credibility to take a deal can take a great deal and completely hose the whole thing up. So it doesn't matter how good the deal is. Ultimately, it is your operator that will define.
Yeah, that's great. What about you, Ellie?
So, I don't think what else you can add to what Christina said. She kind of summed it up pretty beautifully. I think that it's extremely important to know who you're investing with because, for many syndicators, I think many syndicators are buying similar deals in similar markets, and it can get a little bit confusing, and it's hard to understand. Sometimes it's hard to understand, is this a good operator? Is this a good deal? How do I know, now I'm looking at 5 or 3 different deals. How do I choose who to go with? So actually doing the research up front, talking to other fellow investors, understanding from them how, what their experience was can really make or break the deal. Because like Christina said, a good operator is sometimes, and do not quote me on this because I know sponsors don't like to talk about it, but if the deal goes south, they'll waive their fees. They'll waive their equity, stake to make investors happy. And that's the type of sponsor you want to be with. Someone who doesn't really care about the check they're taking home tomorrow, but keep everyone happy. So they'll come and invest with them again and again and again. So someone who's more focused on the long term. That's why it's so important to understand if you're investing with someone who is investors focused, or they're more fee driven, and it's sometimes a bit hard to understand and to kind of make that distinction.
Yeah, I think we try to look at the idea of partnership, right? It's the idea that you're partnering together, your interests are aligned, and I like what you were sharing. That was really good. Spencer, what about you? What are some things maybe you'd add to that? What should people be looking for in a sponsor, or why is the question so important? I guess we can start with that.
Yeah, happy to share. I think alignment is the word that comes to mind. I also think back to my technology career before I got deep into this wonderful world of commercial real estate. Frameworks are the way that so many fast-growing businesses or even real estate projects can be set up for success. And what I mean by that very specifically is like there's 5-point framework that I look at when I'm vetting a sponsor. And I also like numbered lists, so it's just a nerdy thing from prior life. But the things that I look at specifically for a great sponsor that I want to go down, each of these has sub bullets, which I'm not going to put people to sleep with, is really just, track record. I want to understand what they've done. Comms, like communication. How do they communicate effectively? Their approach, just generally their approach to the project. I want to understand really like the legal and the team side, just distinctly, because if 3 partners are on a GP team and they stop getting along 3 years in out of a 5-year hold, that's a breakup. That's bad. And then last but not least is really, this might sound corny. I think some folks in real estate tend to kind of think of this as too squishy to be pragmatic, but I really believe firmly in this is values, frankly. I mean, I think you can actually get to know people based upon some sense of prior decisions that they've made, and so like what's their value set, as a sponsor. And so we actually have made legitimate partnership decisions about who and who not to work with on deals in the past 2 years based upon on those criteria. So that's kind of my nerdy 5-part framework to try to tie it in a nice bow. Of course, I don't sit there and grill sponsors before I partner with them based on 70 questions in a row, because they would run screaming. But that's kind of the high level how I think about it.
I was just I appreciate what he says, because I'm one of those people who has like 20 questions I do grill them on. I have to confess,
I know you do.
I do. You But at the same time, it occurred to me to give an example. Like, to get back to your question, let me give you an example. So I invested in a syndication that was in Texas, Arlington, Texas, that was an apartment building that was outside of the new stadium that they were building at the time. I think the stadium is now done. And it went south. The deal went south. And the sponsor had put in his own money in order to not do a capital call, right? But when the deal continued to go south and we had to sell it at a loss, he got his loan back, right? And he got his investments back, but the investors did not. And so we were all rallying together to potentially sue, because it's like, well, how did he get a loan? I mean, legally, yeah, he can structure the deal so he gets his loan back, because debts are paid first before equities are paid back. So correct, legally, he could get his loan back that he had given. But we were like, wait a minute, how did the sponsor's money become more important than our own money? So we were looking to sue him. An example on the opposite side, I mean, I can go through the example of what went wrong in the deal and why it went south, but I'm going to leave that. An example on the opposite side was I'm not a syndicator, to make it very, very clear. I'm not a syndicator. I am not a fund director. I don't do any of that, but I do have people who invest in my projects. I had a project that went south that cost $350,000. Guess who paid $350,000 to my investor to make my investor whole? Right? So it really is, he hit it. It's the character and the integrity of your sponsor that defines not just will the deal go south, but what happens if it does. Are they looking at the long run? Are they looking at just getting out of this project because it's all they can do? Or do they have a long-term trajectory and a loyalty to the investors because they're going to go do it again and again and year after year? And this is just a thing that they're doing. They want to invest in their investors, not in this exact project. So I have to agree with what's been said.
Yeah, yeah, absolutely. I think, the ability to make investors whole, or just really say, hey, we're going to do whatever it takes to make it right because it's the right thing to do. And I think the right operators have that mindset that, the reputation and the experience is more important than actually how the investment turns out in a way. So we're going to jump into it. One more sec here. I wanted to just go to the chat. If everybody can go to the chat and just type in where you're coming in from, because we got a few more people that joined. So if you can go ahead and do that. And then also we have a little poll I'm going to put out here. Basically just how much experience do you have investing in real estate deals? So passively. So if you could put that in there, just, click on there if you're a newbie or if you've done a bunch of deals, just so we kind of know who's on here. We can kind of tailor some of it to, who is on the webinar here. So it looks actually pretty even so far. So we've got, can you guys see the poll as well on the panel? You guys able to see that? So you got pretty much no newbies. We got some people 1 to 2 deals, 3 to 5. Okay, 1 to 2 deals. Awesome. Okay, cool. So let's keep going on this. Maybe Ellie, do you have some examples of maybe just things where you've seen either in your deals where things, I know in real estate things don't always go as expected. They go better than expected. They go worse than expected. Everybody that owns a house, knows that that's true. It doesn't always go exactly like clockwork, right? So maybe some examples of ways things, can go well, or things that you've done, or even maybe things that you've seen other operators do that, haven't gone well. Any stories that you have you'd like to share?
How much time do you have?
Well, we've got to the top of the hour.
I'm going to try and be brief and just really kind of talk about the main highlights. One deal that initially went south was a deal that we purchased that when we put the deal under contract, it was 98% occupied. And apparently the seller was hiding the real numbers. And by the time we got to the closing, 4 days before we're actually closing, where financing is all tied up, investors' money isn't, everything is lined up, we basically get a very disturbing email from the property management company. And this is after we toured the property. We didn't see any signs of distress, because after we left the property, things started to escalate. And apparently the property went from 98% occupied to 82% occupied, and was no longer technically eligible to get Fannie Mae loan, which is the loan we really wanted. It was a very attractive loan, very low interest rate. And then you pause and you say, okay, what do you do? What do? You have 4 days. You may not have a loan, and investors invested knowing that this property is 98% occupied. So the first thing that I did was, okay, this is the situation, and what do we do? And basically, long story short, we got certain discount from the seller, because we could have taken him to court and he would be dragged for years. And who's paying for it? Investors, and their money is still tied in this. And basically I said, you know what, you can go through this route. I used to be a real estate lawyer, so I know very well how not well those things can work. And I said, let's just focus your energy, your team's energy, in making this a great asset instead of being dragged to court. And so we had a plan on how we're going to push occupancy. And once we had the plan ready, and it was a matter of, a few days, we negotiated with the lender. We still got them, convinced Fannie Mae to give us the loan. And just, Fannie Mae does not give any loans unless you're 90% occupied for 90 days. And we were able to get them to keep the loan. And I said, okay, there's no way investors are going to hear about it after we close. Basically, I sent out an email and said, listen, this is the situation. It was 98%. Now it went down to 82% because he evicted a bunch of people. If you want out, let me know before we're closing this. And I said, if we need some more money, I'll borrow the company, or I increase my investment. And nobody wanted out. I said, here's the problem. Here's how we're going to fix it. These are the steps, 1, 2, 3. If you want out, let me know. Nobody wanted out. The property is cash flowing. We were able to push it back to 90% within 45 days. We're paying 9% cash on cash today, net to investors. So it turned out to be okay, but it turned out to be great. But at that moment, you really don't know if that can go south and the property is going to deteriorate, or you can save it. So we were able to push rents during COVID by 25%. It was a great asset because the rents were under market, but the short-term pain was that high vacancy. But we turned it around and we're able to capture, there was a lot of meat on the bone, but the bone was a little rotten. So we had to make some tweaks. So.
Yeah, I love that you really took responsibility for, it wasn't necessarily your fault at all, but you just kind of got as involved as you needed to be and said to investors, hey, if you want to back out or if you want to change, you basically gave them a lot of options. And also as well, it seemed like you had the financial ability to either borrow or increase your investment, which a lot of groups, especially people that are just starting out, they don't, sponsoring groups don't always have that ability to do that. So sometimes even that's why reputation and, people have been doing it longer. Usually there's more wealth there, and it's the ability to come in and make investors whole, because not every group has the ability to do that, especially groups that are a little bit newer. So I like that you shared that.
Yeah, but it's pretty straightforward. Just treat investors the way you would have wanted to be treated if you were on the other side. It's that simple. I would want to know if something happened and have an option to take my money or to stay. With investors, of course, it's painful if something goes south, but not communicating and not being truthful is trying to mask the truth or, act as if things are better than they actually are. These things are kind of the death kiss, because these are the type, I think, of behaviors that investors do not appreciate. They understand there's a risk. They understand you can't control everything, but just tell them what's going on. And we did the same with COVID. I basically calling each and every investor saying, we're not sure what's going to happen. I'm just going to tell you what I see in the market, what's going on. And it's just about communicating, and that what makes investors just feel more comfortable.
Right. This is the thing when people invest, whether it's somebody for the first time and they find out, man, if the communication stops, or, you said 50K or 100K and you're like, what's going on with this? So I think as a sponsor, we always try to really over communicate or just communicate too much rather than not enough, especially in the beginning, just so people know. And then also if things are not going, something happens, like you mentioned, where something does not go according to the plan, I think that's really great to be able to, like you said, treat people the way you want to be treated. Spencer, what about you? What's a story that you want to share? I know you've been doing this a long time. You've got a lot of ins and outs. Why don't you tell us a little bit, some stuff that you've seen happen, or positively or negatively?
Yeah, I mean, probably one of the most unfun examples was back around, around April last year, at the time when in the market, everyone was pretty scared. I'd like to meet someone who can claim that they were feeling great about things, right? Pandemic was new. Pandemic was very new and it was peak fear for all intents and purposes, right? And so we were actually right smack in the middle of a pretty substantial 2 different raises. And, we had to actually see one deal totally unwind just because, a lot of the economics of that deal were not the same before and after. And so for a few different reasons, but also because of the financing conditions changed. So the whole deal got unwound, and we had to return millions of dollars of investor capital. And I will say that was a really, in hindsight, like an incredible trust building experience with investors. Like it was really touching to get some of these notes back. I save them. It's the kind of stuff that you save because you want to read it when you're going through a tougher day. But in those moments when you're like, oh, wow, Spence, I'm bummed about the deal, but frankly, I'm absolutely going to be working with you guys in the future because of the way that you've handled this and how much you proactively over communicated. I was doing recorded videos instead of just sending, a MailChimp or a written email on a, twice a week basis, just to make sure people felt informed, And so it's that kind of stuff that really just makes all the difference in the world. And you have lifelong relationships with people just because you treated them with that level of respect. And sorry for the background noise. My kids are literally trying to break in the door right now, so I got the door locked on. Sorry, guys, you're not getting.
It'd be like that interview where the kids are coming in and the mom is like diving in to grab the children. Have you seen that interview? It's hilarious.
I have seen that interview. Yeah,
that's going to be you in a little bit, and we're recording, so we'll get that. That'll be viral here. So
we're talking about pandemic life, right?
Exactly. Earlier, it was the gardener was coming by during my first answer, and I almost wanted to go, Bronson, don't answer me first. I got this. Watching the lawnmower go in front of the window of my office.
I know. That's the worst when I'm recording videos when that stuff happens, or airplanes or other things. But awesome. I want to ask each of you. Yes, Christina, you have
Can I
something
ask one other little point?
Yes,
So
please.
one of the things I do because I'm a hard money lender as well as I invest in syndications and funds, right? One of the things that I do is I want to hear the story where it went wrong. If they can't give me a story where it went wrong, and they can't tell me what went wrong, how they fix it, and what did they learn from it, which is back to the concept of character and integrity, right, and expertise, I'm not going to invest with them. If they literally tell me, I've never had a problem, I'm like, yeah, I'm never investing with you. and it's either they're too young, they're not experienced enough, or they're not being transparent enough. But whatever reason it is that they're not having had a problem and having tested themselves by facing it, I just, the proof's in the pudding for me. So what'd you do? What was wrong? What'd you do? And how'd you fix it? What'd you learn? So
totally agree with that commentary. That is spot on.
Yeah.
Things perfect people.
That's it. I mean, Christina, I think you did something you taught me years ago, was just like, go around meetups and ask people what went wrong with them. You're like, people, how you doing? Hey, nice to meet you. Well, tell me what went wrong with an investment. It's a real conversation starter, but it is really true how people handle that. And if they haven't had any issues come up, because I think the more I've kind of gotten under the hood over the years with, especially multifamily or larger real estate, is that it's you try to make it a science as much as you can, but things go better, things go worse. It's in different areas in a certain deal, and you hope it kind of averages around 15, 18%, whatever the amount you project it, right? So it's this kind of like art and science kind of together. I wanted to ask another poll here. This is basically to our group here, and it basically is, what do you think is the most important thing when vetting a sponsor? So I didn't have everything on here. I didn't have that last thing about tell us about the worst thing that ever happened to you, but that could be the last option. But I want you to go ahead and fill it out. So is it years of experience, the type of experience? So again, somebody who's invested or operated a certain type of asset, the sponsor being honest. I guess that would fit Christina's thing about just hey, what happened when something went wrong, or the investment goals. So can you guys see? You guys can see that right on the panel. You guys can see that. So in the audience here, go ahead and just fill that in. And then we're going to kind of keep going on this, but I wanted each of you, Christina, you shared something really valuable there, but for Ellie and Spencer, if you were to kind of look at one thing, this is kind of the one thing as a sponsor group that, as an investor, you would look at, what would be that one thing for you? Or what is one thing, I should say?
Yeah, I mean, just to pounce on it, but I got to say that this question is making my head explode a little bit, because I don't want to work with a person who has tons of experience but is not honest. And so I would love to work with someone who is honest above all. And just to throw in a slightly contrarian comment, I know this has got to be one of the most debated topics, and certainly within commercial real estate and syndication specifically, is how much experience is enough, right? I tend to lean on the more open-minded end of the spectrum when it comes to years of experience. And the reason for that probably is because not only the fact that I think my technology career, I was always surrounded by people. I mean, I'm only 37 here, guys, and I got to say, I'm already considered a dinosaur in the tech world, which is just mind-blowing for most folks, right? So like that's my lens coming in. Within real estate, I got to say, though, there are some, like, call them one-cycle sponsors, and they haven't been through two or three. And there's a subset of LPs out there, passive investors, that just write them off right out the gates. They're like, nope, not touching you guys. To that, I would also say there's a bell curve. There's a bell curve of effectiveness for sponsors, because eventually, when you have enough zeros behind your balance sheet, I challenge them to care as much as a person who's still got the hunger. So that's my counterpoint to a person who says they only invest with 3-cycle sponsors, and how much weight I place is I just want them to be honest and have integrity at all costs. I want to know that they're going to go above and beyond and work tirelessly to make sure that the investment is protected. I try not to get too soapboxy on the topic, but I'll just say there are ways to ensure they're competent and they have the ability to actually complement their team with people who know how to manage the asset, how to do the construction, how to do all the value add components. But that's my 2 cents on the experience level. But they got to be honest, man. They got to have table stakes. Integrity's table stakes for sure.
Yeah, absolutely. That's I think it's interesting. This honest thing has come up as well. I don't think the audience is able to see the poll results, so I'm just going to share what these are. Then we're going to come back to Ellie on hers. But the number one is 53% is the sponsor being honest. So no surprise. I mean, it's if somebody's not honest, how can you work with them, right? So just really knowing, and that's, I think, when people start to feel like, I think that's what they say in sales. The first question is, can I trust you? And then the second question is, can you help me? And so if you can't, if you answer the first question, if there's not a trustworthiness of like, wow, this person is actually someone that I can trust or I value, that's why a lot of people start, doing investing, or they start syndicating with friends and family, right? Because friends and family know, at least I can trust this person, that they're going to do the best that they can. So trust is really important. The second result is years of experience or track records. That's 28%. And then the type of experience is 14%. And investment goals, people said 0. So your investment goals or the cash flow, that's just not as important as the other stuff. So Ellie, what about you? What's kind of the number one thing for you that you look for when it comes to a group, or you would look for?
So I'm actually going to surprise you a little bit. Of course, honesty is important, but I think there's another aspect that maybe many passive investors are not paying a lot of attention to, and that's fee driven. So if the sponsor that I'm working with needs those deals to pay their bills, to pay, for the company's expenses, they tend, and I've seen it around me, they tend to make decisions that are not necessarily in the best interest of investors, and not always in a conscious manner. So if if I'm going to close this deal, I'm going to raise money, I'm going to make, acquisitions fee, sponsors are being paid very handsomely. And, if I close this deal, I'm going to make 6 figures that I really need. Then when they're looking at the underwriting, all of a sudden, maybe rent growth can be 5%. Maybe, delinquencies are going to decrease in year 1, even though we're in the middle of a pandemic. And, on my assets, we collect 96 to 100% month over month, but we had months at 92%. And I don't know if, 6 months down the road, the delinquencies are still going to go down. So I'm assuming when we're looking at deals, actually, worst case scenario, very, very minimal or 0 rent increases, higher occupancies, higher bad debt. Let's see if the deal still works. And when a sponsor is fee driven, it makes them look at things a bit more optimistically because they really need that deal. And so I get a question from investors a lot, that investors that speak with me for the first time, how many deals do you do a year? And I always laugh because I don't have a set number. If it's extremely competitive, I'm not going to buy every quarter just to do a check. It doesn't work. My last deal was 6 months ago. It was a pretty large deal, $80 million deals in Atlanta. I thought I'm going to do the next deal in Q1. We're approaching the end of Q1. The market is the most competitive since the last recovery. The most competitive, even before from 2 years ago. Cap rates are at all times, they've been compressed. If I cannot find the right deal, I'll wait until we get to the right deal. And so not being driven by fees really gives the sponsor the opportunity to look at each deal and really pick the deals that make sense. And if it means waiting a little bit, and I had investors that were ready to write a check, and there were just no deals that I could see that were good enough for me and for my family to invest, because we're always investing on every deal. And so they invested with another sponsor, and that's totally fine. So for me, if I try to assess if really, and that's a problem, I think, with some sponsors, with others, it's not an issue, but if you're fee driven, then I may think that there are other considerations there. So I may dive a bit deeper into the underwriting and try to understand if the deal actually works.
Yeah, I think that's a great point. I mean, being, fee driven and just somebody with the fact of doing a transaction is a big deal versus actually having some sort of, alignment of they're putting a significant amount of capital. And we're going to get into that in a little bit as far as the skin in the game question. But, basically, yeah, just people that are just doing deals. I mean, imagine it's the asset under management model that we see with Wall Street, right? It's just, just buy and hold, hold your stocks. Even if things crash 50% or things are at all-time highs, and you're actually at a more risky position because things are so high. And but yeah, let's keep on that track a little bit. I want to ask. I want to start with Christina, because I know this is a lot of what you do. And we are going to have time for questions kind of toward the end. So feel free. We're going to come back to some of these questions. You can put them in the box, or we will come back toward the end here. But Christina, one time you told me, you said that you spend upwards of 10 hours per deal kind of vetting a deal or vetting a sponsor. So can you maybe break down kind of how, if you're going to do a deep dive on a deal or a sponsor, how would you even go about doing that? Or how do you go about doing that?
How do I go about doing that? Yeah, it is generally anywhere from 5 to 10 hours. That's true. And it part of it has to do with their depth of experience, and part of it has to do with how distracted I get while I'm doing it. So, because it really is a little like Alice going down the rabbit hole. So, I start with a conversation with, usually the deal's brought to me. There's some blah, blah, blah. This is the deal. Let me give you some information about it. 15-minute phone call, 30-minute phone call, something along those lines. And then I go, okay, great. Send me your marketing material. So I read through all that marketing material, and then I go, I think I like the basic concept of this. And I might even do a little bit of Google search at that point, maybe on the name of the company and on who the principals are, right? Just a sort of quick look. Right. And then I go, now send me, I sign my disclosure. Now send me the PPM and the LLC agreement, the financials. And I read through all of those. And I don't know, maybe people are faster readers than I am. Ellie is probably a faster reader than I am for sure, given that her lawyer background, but it can take me anywhere from 2 to 3 hours to be able to read through, because I read pretty.
I think you just froze, Christina. So I think she's saying that she reads every word. So maybe she'll jump back on here in a second. But yeah, the level of depth and the level of research that sometimes we need to do on sponsors can be extensive. So what about Spencer? What about you? Anything you would add to that question as far as, I know you had your 5 points, but what are some steps that you take when you're looking at vetting a sponsor group? Because I know you do quite a bit of that as well.
Yeah, happy to. It's evolved a lot for us in the past few years too, Bronson. So, initially we had those 5 criteria with a bunch of sub bullets and a nerdy spreadsheet. And we always go through those interviews and grill them. But that said, we decided to make it even more robust. And so what it really ended up looking like now in reality is, if a sponsor reaches out to us, years ago, it was more like, please work with us, big sponsor. We're so impressed with you. And now we're very blessed that sponsors reach out to us. And just for the audience that's checking us out, so I'm a co-sponsor. That doesn't mean I'm like the asset manager sitting in the state. I'm brought into GP teams, or I'm like operating as a placement agent on a fund, perhaps. It just depends. But now I'm a registered securities professional as well. So there's a whole other layer of diligence and background that I'm legally held to disclosure, legally held to review every word of every PPM, every element of that. In addition to the fact that before we even go down that road, we get to know each other for like 3 to 6 months. Like we're pretty slow and pretty deliberate, and it doesn't sound very exciting and boring when you say it that way, guys, but that's kind of the way that I prefer to operate. I don't want any surprises. And so like the last sponsor we ended up connecting with, and we're on our 3rd deal with them. They're based out of Texas. They're a storage sponsor. I met them at their offices in Dallas. We got to know each other there, met their staff. And that was kind of the beginnings. And then eventually I said, hey, would love to be able to put you through a background check without weirding you out. Is that okay? So we paid, it's a very reasonable fee. Happy to tell people it's like $1,000 for the version we did, pretty robust investigative background check. Go through that whole thing. Hopefully it's not exciting. You don't want an exciting background check. And so it came back very clean and very boring. And then it just goes from there, and there is an element, I would say, of both qualitative and quantitative review. And so, yes, those nerdy 5 criteria that I had earlier, but there's also that notion of partnering and collaborating with them. I think the one call out I would want to make here is that a question on multifamily specifically that I've started to ask, and it's really, really telling. I think it's more important now in the pandemic than ever, is, what is your established philosophy on tenant relations? And I'm not looking for them to hand me like some kind of dissertation document. I just want them to have hopefully thought about it, and we've actually passed on partnerships for that reason, because right now, I see the sponsors that are thriving and shining and navigating and bobbing and weaving through all these twists and turns of, particularly if they're in C class and they have to get stimulus assistance and all that stuff. they have to partner and collaborate with the people that live in their buildings. And so, just to give one very specific example of a question that I have found to be incredibly powerful when getting to know folks and vetting them, starting with the dry stuff, like, of course, you got to know what, do they have a physical office? Do they have a staff? Is there infrastructure that they say that there is? It's not just a flashy deck, and really taking the time to go and look under the hood. But yeah, the securities thing kind of dials it up to a whole new level, because, I have to go and put together a big old deal memo package just so a broker dealer can approve it and all that other stuff too. No bad actors financially are allowed in the transactions because of that. So you can't have, any kind of financial felony on your record. And everyone, it's all about good people, clean money. All those requirements have to be met, but that'll put people to sleep if I talk about that more.
No, I think it's really good, Spencer. You brought up something I think a lot of people don't understand. So a lot of people think they're investing in a deal and they're, whoever they're investing with, that they're always the operator. And that's not always the case. Like for what you and I do, it's more, we're partnering with people that are operators, and we find people that are doing things in local markets. And so in a way, we're almost functioning as, really diligent passive investors and bringing people into those deals, which is a different role than someone like Ellie, who's actually operating the asset itself. And so it's just something a lot of people really aren't aware of. Then they're kind of almost another level of diligence, right? Because people may have to vet you as a sponsor, and also vet the operators actually doing the day-to-day management of the property. So I think that's really good to bring up. So we're going to move over to Ellie, and then we'll come back to Christina. So Ellie, what other comments do you have about that, or what we were, that road we were going down, as far as your list of, diligence items or things that you look at?
I mean, being a sponsor, I actually know a lot of the groups around me. So, their reputations. We hear everything. It's not a very large circle. We hear, which sponsor is doing well, which sponsor is not doing well. I tend to invest with sponsors that we're affiliated with a family office. So we've been investing with several groups for years and years. So there's a pretty interesting track record and collaboration there. And one of the first investments that not me specifically, but someone from the affiliated family office did, they made 40% IRR, and that company gave them a call and said, listen, we got lucky. This is not a standard. Don't expect the next deal to be as good. And he keeps telling me that story over and over again, because that's what, made him an investor for life. And he invests with them for years and years, because they were honest and humble, not only when things, went south, but when things were great, to say, don't think this is the standard for every deal. But generally speaking, there are sponsors that, were kind of in the same arena, but maybe they do something else, maybe in different markets, or maybe they, invest in self-storage. We know, you meet them face to face, you hear about them. It's kind of part of the inner circle. So maybe it's a bit different than a passive investor looking to vet a sponsor. But there are some conferences that you can go if you're really passionate about meeting those sponsors, in the flesh. You can go to some conferences and meet them, grab dinner, grab a cup of coffee. I had some folks, normally, family offices and large check writers that, if it was important for them to make the effort, come to the conference, and then you sit down, you talk with them. It's another level of relationship that you don't really get when I'm speaking with someone for 20, 30 minutes over the phone. So that's also one of the challenges of kind of vetting the sponsor. And the vetting never ends, I have to say. The fact that you've done one deal doesn't mean that it's going to be great on every deal. Keep communicating with sponsors, keep asking questions, just share information, have periodically calls with them to see, because things change. I don't remember who earlier said something about partnerships break up. How would you know if the sponsorship team that you've been investing with, if there are any issues, if you're not going to maintain an open line of communication? It's going to look like everything is okay. So the vetting, in my opinion, never really stops. It's vetting / building relationship that should be continuance. And that's what makes the most informed investors, because those investors that I have that level of communication and relationship with, they know me really well. They know what's going on a little bit more than investors that don't. And it's totally fine. It doesn't mean that, if you're not that type of investor, that's totally fine. But sometimes the vetting can go a little bit, it just extends beyond just the initial introduction and, making the first investment.
Yeah, I think that's a really interesting point too, of like it's not just getting a certain number of sponsors you're comfortable with, it's also keeping in touch and really that relationship. And I think that that's kind of how I think of it as an operator, where it's not the deal that we do. We'll get people, and I've had 1,000 calls with investors over the last few years, and it's like, get the doctor that has $5 million, never invested in real estate, and he'll put 50,000 or 100,000 into a deal. But it's like, to me, it's more about the relationship. It's about doing deals in the future. It's about making sure he has a good experience. And I think good operators are going to do that. But you're right. If there are changes in the way that the partnership is working, it may be a whole, things almost not necessarily a restart, but you're having to kind of go back and do a lot of that again. And it does come through just being in touch and staying close. Christina, what else do you have to add to this now that you're back? Welcome back.
Thank you very much. I have this fancy new computer that seems to turn itself off whenever it thinks there's something wrong with his BIOS. So there you go. That's what I get. Where I was, it sounds like Spencer kind of took it down the line, which was great. Thank you, Spencer, which is, you have the conversation, you get the PP, you get the marketing materials, do a little bit of research, just enough to make sure that you kind of have an understanding, sign the agreement, get the PPM, the financials. That's when I read through everything. And I actually have a checklist of things I'm looking for. How do I get in? How do I get out? Right? Because there is some way, even though they're not marketable securities and you can't just sell them, there is some languaging about how I get out if I need to get out, right? So that needs to be covered. How is a dispute handled, right? What do they do, right? How do we get them out? What are their fee structures? What do they get, right? What is my voting rights? Right. And so that's another batch of information. And then some basic stuff like K1s and the financial position on that, capital calls and how do capital calls happen? Are they covered? Right. And a dispute resolution. So there's certain things I'm looking for being covered. And the important piece to me is I'm kind of also looking at a culture. What's the culture that the contract is written out of? Right. I will give you an example of culture. So I read one agreement where the only way you could get the managing member out was if he was found guilty in a criminal law of fraud and sentenced. That was the only way you could get him out. And another one, it was, you could write a letter and they had 30 days to respond. And then they used this communication building conversation was built in. And so it's a little like, this guy clearly, he could do fraud and you can't get him out and you couldn't necessarily do anything about it except to take him to court and then find him guilty. And he's using the funding money, he or she's using the money of the funds in order to defend him until such time as it's done. And it's not so much that I'm expecting this person to do fraud. It's not that at all. It's what is the culture that's being stated in the agreement, along with other cultural statements, right? About what my voting rights are. What are the majority members, 80% members, 90% members? So I'm looking for the culture inside the contract that is protecting the sponsor as well as the investor. So I'm not looking for them to protect just me. I'm looking for a balanced culture that has been thought through that makes this a working relationship between effectively two sets of people, right? So so I'm looking for that as well. And then I do the Google search and I do the check on the LLC. Is their standing good? I do a background check. I use TLO to do a background check. So not nearly as in depth as Spencer's background check. Clearly, I am looking for fraud. I'm looking for criminal record. I'm looking for liens, foreclosures, and in the background check. And if a sponsor won't let me do a background check, if that kind of does freak them out, and I try to do it at the end of my process, right? I've tried to develop a relationship with them. I've had a phone call with them after I've read the PPM and the LLC, and I have a phone call with them. And at the very end of that phone call, after I do all my little questions, I say, hey, I'd like to do a background check. It just makes me feel better. If you have any problem with me doing that, just give me your full name and birth date. And if you're not comfortable giving me your social security number, and is there anything I should know? Because I had one where a guy came up with a criminal record as being charged by the SEC, and it was a little like, okay, no, you don't want to get involved with that guy. But he told me, no, I was the whistleblower. But they named me, the SEC named me, and I walked through it, and he was able to send me the documentation. And he really was the whistleblower, and he really was unhappy with what was going in that environment. And he was able to tell me what went wrong, how he dealt with it, and what he learned from it. And that clearly his position was one of integrity. His position was not one of non-integrity. And so therefore, my client, after presenting all of this to my client, they said, you know what, I'm comfortable with this guy. I'm comfortable with the transparency. I'm comfortable with the history. I'm comfortable with what we found out. I'm comfortable with the consistency of word from the beginning of the communication to the end of the communication, the consistency of who this person was in our relationships and in our conversations. So I do have a whole series of steps, and it does take me 5 to 10 hours. And sometimes it is a fun little rabbit hole to look at deeds of trust that they've signed, and this property and that property, and what are the things that they've invested in the past, and how many different business names have they had, and do a background check on each of the previous business names I see in the last 5 years. And I mean, it's just kind of like Columbo. I just kind of enjoy it, but it does create a whole picture. So, but again, it's not the exact details. It's like Spencer and Ellie said, it's solidity in your experience, and solidity in what you've done, transparency in what has occurred, and what did you do that in your response to the situations that I do run into with people. So
sure.
It's not the perfect person. There isn't one.
Yeah, no, that's great. I appreciate the depth on that. So we're gonna do this. We're gonna do a couple more questions, then we're gonna get into people's questions that they have. We're gonna try to kind of just not necessarily rapid fire, but we're gonna just kind of do some questions, and I'm gonna ask a couple things specifically. But first question is, how important is it that a sponsor has skin in the game? And let's go to Ellie first on this one.
One of the most important things, in my opinion. And skin in the game is a sentence, it's a phrase that I hear a lot, and it means different things to different people. I think skin in the game, there are multiple ways to have skin in the game. One of them is, do you invest in this deal? And just to be fair, especially if you're just starting out, not everyone has the capital to invest. So do you feel comfortable taking perhaps some of your fees and invest some of them? And if you're not investing, something that would make sense, why? Maybe you decided to reinvest the money in your company. Maybe there's some other circumstances, but for the most part, what I see around me, and it's also something that I do, and we have about 2,300 units across the US, over 300 million in assets under management. I invest personally on every deal, and not only myself, but my brothers-in-law, my father-in-law, my husband. We invest separately, but also together on some deals. Some deals he likes, and some deals I don't. But on the deals that I'm syndicating, my entire family invests. So if it's good for my family, it's good for my investors. If I cannot it's one thing to bring a deal to your investors if it's kind of can work, cannot work. But if you're sitting around Friday or Saturday, dinner with your father-in-law, and this deal is going to go south, you want to make sure that the deal is solid. Let me just say that. So that's something that investors really like to hear. I think that's one aspect of skin in the game. Another aspect is who is signing on the loan. And again, in order to sign on the loan, you need to have certain net worth and liquidity requirements. If a sponsor is just starting out, they may not have it, but it doesn't exclude them from signing, even if they don't qualify to be the only person signing. Why aren't you signing? Why aren't you willing to take responsibility? So sometimes when you're just starting out, or if you're doing mega deals and you need other KPs, key principals, those who sign on a loan, they pay them something or they give them a piece of the equity. It's totally fine. But why aren't you signing on the loan? In addition, it could be either because you're scared of taking responsibility. It's a major red flag, and I've seen it also before, there's something in your track record, going back to what Christina said, bankruptcy or anything else, agency, debt, Freddie Mac, Fannie Mae, they're not going to lend for someone with anything on their track record. So anything, of course, criminal or anything, even financial speaking. So I think these are some parts of skin in the game. There are other ways to show skin in the game, but these are the main two that I can think of, is taking financial responsibility by signing on the loan with a loan or with other people, and investing your own money.
Yeah, thanks. That's great. It reminds me, actually, Bruce mentioned this too, that it kind of something I think Spencer had talked about with the idea of fee driven, and just the idea of someone's fee driven, you can kind of also look at their net worth. They have no net worth. Sometimes they may not sign or be willing to sign, or they have issues in the background or things like that as well, which is a great point. Yeah. Spencer, I'm going to ask you, give us just maybe one example of a conservative assumption in a deal, when somebody like he's looking at a deal, like this element makes this deal conservative.
Yeah, happy to. I mean, I was going to say by far and away, but there's so many things that go into a good underwrite. I was going to say rent increases right now, proposed rent increases and the speed of them being implemented. Year one in particular is an interesting bird right now, because you're seeing a few pro formas that are out there where they're like, don't worry, we're not raising the rents on a 5-year hold of a value add multifamily deal. Just take a look. Year one, it says 0. Year two, it says 0.5. But then I'm like, well, yeah, but why does the spreadsheet show the last 3 months is this? And you kind of left out the fact that there's like a 30% jump between the one between the T3 and the one that then you're starting.
It's a rent bump, right? No,
I was like, I don't understand where that gap is reconciled, buddy. But that, I mean, all joking aside, rent increases in a proposed value add plan has got to be the number one.
That's very true. I see that all the time too. That's very common. We're going to do questions here in a second, because we're getting kind of the top of the hour here. Wanted to let you know we are doing these events monthly. We actually have 2 a month now. I'm going to share this with you. This is an event that's coming up. This is the Phoebe Multifamily Group with Christina and I. We are meeting with Matthew Owen, and this is going to be April 7th, I believe. Melody, my assistant's going to put in the link to this. You can go ahead and join that. And then the second one, so that's 2 weeks from today. And then there's another event. We're just trying to find a way to add value to individuals through these events. But this is an event, is what's the best investment now, cryptocurrency, real estate, or precious. Looks like the metals got cut, precious metals. So it's going to be a really fun event. We're going to have some healthy debate. We've got Kathy Fedke, David Morgan, and Johnny Caldwell talking cryptocurrency, real estate, and precious metals. It's going to be awesome. So check those out. Those should be in the chat here in just a minute. Also drop your questions in the chat. So we're going to have time for a little bit of questions. So we're going to go ahead and jump through those. So Melody did drop those in the chat. So I'm going to go back to the questions we have. This comes from Gene. Oh, looks like
John. I'm sorry. I just have to say, John had a great question. What do you do if your sponsor has a relapse? Oh, wait a minute. It's just the wrong meeting for that.
yeah, exactly.
Question. I'm sorry.
Well,
I love a good joke, so I just had to highlight it.
I didn't even get that the first time. But that was really good. John, you're a gentleman, a scholar, and full of humor. So Gene is asking, kind of, again, the honesty question, maybe, and I don't know if maybe one person wants to take this of, for you personally, what's your worst experience when a deal went south? And, I think Ellie shared some of this. I don't know if Spencer, do you have anything that, not to put you on the spot, we can actually come back to another question, but, or maybe an example that you've, maybe another example you could share, but if not, we can kind of move on from this.
I just don't have one that's like, within real estate that is as awful as some of the most awful that I've heard out there from other folks that have been much more long in the tooth than me, right? I mean, right. So I think a couple examples that are very brief and come to mind. We invested as an LP in a multifamily deal, C-class, Dallas. This is a few years ago. And right after close, it was found that there was like at least $2 million in deferred maintenance that could have been avoidable. So thankfully, the sponsor understood that they messed up significantly on that, and they actually were willing to return capital. So dodged a bullet on that. So that was one. I'm trying to think of anything else that was particularly bad. Different LP investment. So this is a few years back, but got one distribution when it first started. Act of God occurred. And I'll just to be respectful and keep anonymous, who I don't want anyone to figure out who this might be, but let's just say that it was an act of God. Building got damaged. Only had one distribution from the project, and then thankfully got my capital back at the end, and so no other profits coming out of it. I wouldn't even call that the worst. I mean, the worst is you lose your capital, right? And so for me, I don't have two awful stories. I'm going to knock on every piece of wood in my house right now, but those are some.
Yeah, thanks for sharing that. Christina, do you want to, I don't think you shared, do you want to share one maybe that you've come across or that you've been involved with over the years?
Well, it's you're saying as far as difficult stories.
Yeah, difficult story, something didn't go. Your question that you'd asked yourself of what went wrong and how did you handle it?
Well, so if it's my deal, that's that's a little different than if it's a deal I've invested in. So I'm happy. You want me to talk about one of my deals?
You can talk about either one. So I'll give you the open door there.
So in my deal, I would say, my worst deal that I lost the most capital on was I was in the middle of an apartment conversion. I was converting an apartment building into condos, and I had gotten to pink, but I gotten to yellow paper, but not to white. And, 2008 happened and my construction loan disappeared. And, here I am with a building that I had purchased intentionally with a negative cash flow, knowing it was a negative cash flow. And I spent the next year and a half repositioning the building to get it to minimize its negative cash flow. And I sold the building at a distinct loss, because at that time, the fact that it had yellow and would have white paper in a relatively short period of time was not valuable. But I was the only investor on that. So I was the only one that took the hit. But it is one of those things where you just kind of like, well, what did I do? And I tried to make it work. And how did I treat, it was a moment where I had to decide if I was going to stay in real estate or not stay in real estate, because that wasn't my only hardship that was happening at that time in that downturn. But, it did teach me a lot, and like things can go wrong. And Bronson, you know this very well. What did I learn from it was I became an avid hobbyist in studying economics. And I stay connected to all ships rise and fall on the tide. And I have now dedicated myself and continue to dedicate myself and use this knowledge for my clients and for my meeting members on what is the economy and where do we think we're going? Because I might think I'm hot, blah, blah, blah. But I've noticed I've made mistakes, and not paying attention to the economy that my investments are riding on was my biggest mistake. And it cost me the most money in my investment career. So
thanks for sharing that. So we're actually going to wrap up here in a minute. I want everybody, we have a last question, but I want you to just drop your email in the comments there on the panels. If you can just drop your email, maybe your website in there, and maybe I'm going to go around and have people connect with you. But if they have to leave a little early, I just want to make sure that people can reach out to you and get in touch with you. So this is a question also from Jean: during this time, are there any no-go states or cities that you wouldn't invest in? Somebody like to take that?
Yeah, I can take that one. As someone who came from MIT, I'm very data driven. So we keep looking at, there are all kinds of reports that are generated by machine learning and AI. And what I'm looking for is where people and companies go, because many times they go together and they transition together. So right now, core markets, and I haven't touched them even before COVID, because there's zero cash flow or negative cash flow, and you basically it's heavily tilted towards the appreciation, which I think is more risky. It's riskier. So core markets, I would try to stay away. LA, San Francisco, New York, for obvious reasons. And that's, again, just my philosophy. Every sponsor has a different philosophy, and that's totally fine. I like to be in secondary, tertiary markets that are growing, that I see the positive migration of companies and people. And you can go to census.gov and get that information, or even Google the name of the city. If you just type, Atlanta population, you'll see the graph in the last 5-7 years. Where, I want to be where people move. If they move to, that's what fuels the demand. Companies follow people and people follow companies. It's kind of that cycle. And you want the demand. That's what's going to drive the demand. That's how you can raise rents. That's how you can keep your, assets occupied, because you're going to follow where people go. So it can be tempting in some markets, in the Midwest, for instance, where the cap rates are higher, 7%, 8% cap rates. The price per door is pretty low. You can find $90,000 versus, 150, 200K in Atlanta, for instance, or in the Carolinas. But we're not comparing how much you're paying for door. It's how much potentially this door can produce to you, and what's, in time, the likelihood to have this door occupied throughout those 5 years. So it's riskier, in my opinion, to go to a market that doesn't attract people, that actually there's a negative migration or it's pretty flat. People are not going, they're not moving there, then it's going to be hard for me to compete. I want to be in markets like Atlanta. A lot of people, everyone is talking about people from New York right now moving to Florida. They're also moving to Atlanta. So just read those reports. They're moving to Atlanta. They're coming from other, markets as well. People are moving to the Carolinas. It's becoming more and more popular. There are great locations there. So my answer is more about where to invest rather than where not to invest. But just look for the markets where you hear and you can read the data. The data suggests that basically people are moving to those markets. You need demand. Demand is fueling, these are it translates into more legs that are walking towards your properties and wanting to rent. It's as simple as that.
Yeah, I appreciate that. So we've actually done quite a bit of work in Atlanta as well, because there are a lot of people that are moving there, and it's cheaper to live versus some of these other areas. So some of these San Francisco and LA and New York, some of these are a little rough. Anybody else? Do you, Spencer, have anything to add to that?
Yeah, I might have to borrow Ellie's strategy of just saying where I do want to invest. It's a shorter list, but I'll probably just say Texas, Idaho, Colorado, North and South Carolina, Georgia, and everyone not on that list, for reasons very similar to what Ali said. We're very, very data driven from kind of my tech background, and for all those wonderful reasons. Now I'm a cash flow investor. I'm a cash flow investor, so like that context is critical because if I was interested in just purely going for the maximum IRR possible, then I would absolutely be considering looking at certain projects within like LA or within other places that have huge potential, but maybe not great cash flow in year one. So cash flow in year one is very critical to me, but also for our investors that we work with. But I love those states. All of those states offer something a little bit different, but one thing they have in common, to Ellie's really eloquent points, were the jobs. The jobs have already been showing these trends that we were talking about, particularly in states like Texas. I mean, the Texas discussion, as a side note, is an interesting one because, talking about a guy who lived outside of California for 10 years in Colorado, but beyond that, I was pretty much Californian. So coming in like the typical naive Californian, I was like, yeah, Texas, you have no idea how big Texas is. It is absolutely massive. And so look at Dallas as one example. That footprint is absolutely enormous. And so, Dallas being past peak, sure, it's been saturated by most terms. If you're going to go out and try to compete for deals, there's still plenty of opportunity within Dallas, particularly now that you have a laundry list of big employers that are going there, and a bunch of other great markets in places like Texas and other states too. You just have to follow those jobs. And COVID has really, in some cases, accelerated those trends, and in other cases, stopped them dead in their tracks, which is why this is such an interesting and fun business, because it's like, if you don't pay attention to what changed, you could still be betting on a thesis that has fundamentally been thrown out the window, so I love those states. But sorry for the soapbox. I just wanted to
it's great. I think it's really great to know. I was just gonna, Christina, unless you had anything to add at the end here, I was just gonna have people share how they could get in touch with each of you. You're good. Okay. I think you're on mute too. Awesome. Maybe can you just take a couple sentences each person? I think we've got everybody's email in there except for Ellie's. If you just want to drop your email in there, Ellie, in the chat there.
Sure.
But so I'll go first. You guys can see what I'm looking for kind of as we close out. So like I mentioned, Bronson Equity, we do multifamily syndication. We work with passive investors, mostly in the South. And we're always looking to add people to our deals list. So you can reach out to me at bronsonequity.com, or I put my email in the chat there. Spencer, why don't you go next there?
Yeah, and thank you so much for pulling this together. This has been an awesome event. So yeah, Spencer Hiliga, I'm with Madison Investing. We also help passive investors. And right now we actually First time we've ever had, 3 separate funds running in parallel. So please come in and check it out. I'm still trying to find time for sleep, but I'm happy to talk to investors that want to reach out and chat. It's been the busiest Q1 of my entire life, and we feel very lucky to have such great investors. So please do reach out, MadisonInvesting.com.
Well, Spencer, you look great. So thanks for sharing. Even with little sleep, you look good. So.
Yeah, thank you. I'm going off. Appreciate that.
Christina, let's go to you next.
So ChristinaSuter.com. So same as my name, which makes it easy. And primarily, I think, people would want to contact me for my consulting work or my mastermind class. I really love educating people after having, invested for 30 years. I have a few investments that I do that I sometimes take other people's money into, but honestly, that's not my primary focus right now. So, and do not email me, call me. I will put my phone number call me or text me. I will put my phone number in the chat box.
Don't email her. It just goes
into a black hole that I'm not gonna.
I don't know why you have an email. I mean, I think I have to call you and tell you I have to send you an email. So.
Exactly. You text me. If you send me an email, you text me because it is a black hole. And I only have an email because I've managed to say this for enough years now that I really actually only get like maybe 20 or 30 emails a day, which is great in comparison to the 200 I used to get. But it's still just not worth it to me. Texting works so much better. If you want to talk to me directly, then talk to me directly. So
awesome.
I will put it in the chat.
Thanks, Christina. All right, Ellie, how can people get in touch with you? Tell us a little bit about what you're working on.
Sure. So actually, to get in touch with me, you can just Google Ellie Perlman. My website, it's easy. Like Christina, it's ellieperlman.com. And I actually just added to the chat my direct email address, which is ellie@bluelake-capital.com. Was there another question there, or just how can
they get in touch with you? What you do? So I know we've kind of gotten into it, but you're a syndicator, and so people can reach out. to you.
I'm a syndicator, sponsor, operator, and in my spare time, I'm actually also an angel investor, but that's totally different topic, different mindset, a lot of fun. Mostly, you lose money on those deals, which cannot happen in real estate. But Blue Lake that's my company. I founded the company, and that's what I do 100, probably 1000%, because I also don't sleep much. It's when you have a business, it's just everything is different, but which everyone here can relate. But we buy Class B value add in great markets, and we make them better.
That's awesome. Ellie, when you were saying that I'm a sponsor, syndicator, you're saying all the things you're doing. I thought you were going to say rapper/actress. That just came to mind. Just like this other
an actress. Absolutely. She could carry that off.
You get the look.
Heartbeat. Completely.
That'd be great.
No, I haven't done that.
Not yet. That's the next flash, maybe. That's maybe part 2.
Thank you.
But anyway, I just wanted to thank each of you for coming on the panel. Thank you for coming here. This is really exciting for me personally. It's my passion to really help people get educated in investing and through passive investing. I think it's just absolutely transformative. So we're continuing to do more of these events. If you kind of scroll up the chat there, I put in the next couple events there. So feel free to tune into those. And for each of you that joined, really just remember the best the best investment that you can make is really in educating yourself. Because if you don't take the time to educate yourself, basically you can lose a lot of money and maybe learn some lessons, but it's always better if you can learn on the front end. I think it's said that a wise man learns from his own mistakes, but a genius learns from the mistakes of others. So you can always, these stories, asking that question, hey, what's something that didn't go well in a deal, even if you have other passive investors that are doing that. So again, thank you for everybody for joining us. We'll go ahead and wrap up, and we'll look forward to seeing you a couple weeks to the next event, or in a month for this next meetup. So I'll leave this open for just a minute. We'll go. I believe the chat will still be open, but I'm going to go ahead and close the room. But thank you, everybody, for coming.
Yeah, thank you so much.
Thank you for organizing this.
Thank you for organizing this and pulling together.
Okay, thanks, guys.